Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. ASX-listed exchange-traded funds are on track for record growth this year after a surge of investor inflows during the September quarter. There's been huge interest in ETFs for many reasons: relatively low cost, diversification, and access to different areas of the market, from commodities to currencies, option strategies, all sorts of things. But like any investment, you need to understand what you're buying. The inaugural InvestSMART ETF Scorecard report gives a ranking of ETFs based on their performance to the end of August. It tells us the best and worst performing ETFs and gives everything in between a star rating out of 5. Remember, this is general information only, and you should always seek professional advice before making investment decisions. Ron Hodge is the Group CEO of InvestSMART. Ron, welcome to Fear and Greed.
Thank you, Sean, for having us.
Ron, you've been thinking about ETFs for years. I'm about to say decades, I think. It wasn't until legislative change about 10 years ago really kicked the industry off. Why haven't we had a star rating system yet, particularly given how popular ETFs have become?
Yeah, it's a good question, Sean. I think, we've been doing star ratings for a long time. We just, the problem is we haven't really told anybody, which is not a great thing, but we use them internally. We've been using them internally for curating our own expert portfolios of ETFs for our own customers. And we've been doing that, we're about to hit 10-year anniversary for a number of those portfolios. So we've been doing it for a long time. I think one of the reasons why we came out with this report, and this is our first time we've come out with this scorecard, ETF scorecard, is there's lots of different reports in the marketplace, as you'd know, from ETF providers, and most of those are talking about the flows, the new ETFs to market. We're going to hit record highs this year for the ETF industry, probably about 250 billion. And most people believe that it'll reach 500 billion by 2030. The problem is that nobody really tells you which ETF is good compared to another ETF. And like shares, there's good, the bad, and the ugly. And ETFs are exactly the same. And now, as soon as you come up with something like an ETF, everybody else gets involved. And so then they start getting cute and fancy rather than just a pure passive tracking ETF. Then they start using synthetics and they start having active ETFs. And then everything becomes a little bit murky. And so you really don't know which ETF, what's the difference between the ETFs and which ones are good and which ones are bad. So that's why we thought, even though we've been using these star ratings internally for a long time, we thought it was time to shed some light on how we do it and why we think it's important.
Okay, and these star ratings aren't just about returns. There's more to it than that?
Yeah, I think we do it in two ways. So the methodology is, for the passive index tracking ETFs, so take something that tracks the ASX 200, so they buy every one of those stocks in the 200, weighted according to its market cap. That's a passive index, yeah. Mm-hmm. And so you have ones on the S&P 500, you have ones on, everything. Those, we look at 5 things. We look at the size of the fund. We look at the fees it charges. We look at the liquidity of that ETF. We look at the spread of that ETF. And we also, getting back to your point, we look at how well that tracks the index. Now, obviously, if it's doing a good job, it's supposed to track it pretty much exactly, probably less its fees. On the active ETFs, which are those other ones I'm talking about that are becoming, pretty, not popular, but a lot of people are listing them at the moment. Those ones we look at the same sort of 4 as that: liquidity, size, fees, spread. But we then look at their entire job is to outperform the index. So we look at that, at how well it outperforms the index over 1 year, 2 year, 3 year, 5 year, 7 year, and 10 year.
Stay with me, Ron. We'll be back in a minute. I'm speaking to Ron Hodge, Group CEO of InvestSMART. Okay, so what's the top rated ETF then, as per your report up to the end of August, wasn't it?
Yeah, correct. So the top performing ETF for us, and this is really interesting because the top performing ETF is the BetaShares Geared US Equity Fund. Now, if you think about that, now US equities, international equities, especially US equities, has done 36% over the last year, and I think the Australian All Ords has done about 16%. So the international stock market has really outperformed over the last year compared to others. Now, this is the NASDAQ. So then you're looking at the Magnificent Seven. So you're looking at the Googles, the Apples, the Navitas, and so forth. And then you've got gearing on top of that. So if those stocks are doing well, you've also got gearing, and that makes it outperforming this year. I think you're probably going to ask me now, what's the worst performer?
Absolutely.
And so I'll let you ask the question.
Yeah, no, absolutely. So I get that. Well, actually, before we get on to the worst performer then, just on those numbers, do ETFs outperform, active ETFs in this instance, outperform the passive outcome hugely or not?
No, not generally, not over the long term. You have this thing called reversion to the mean. So over the long term, the active ones are more volatile. They'll be better than the index. Some years they'll be worse in other years, and over a very long period of time, they'll probably be close to the index less their fees. Now, because they charge more fees, then generally speaking, as numerous reports show, like the SPIVDA report and whatever else, most active fund managers underperform their index. And that's really why, because it's very hard for a fund manager to get it right every year for a very long period of time. And so you have this, what they call reversion to the mean.
Okay, so let's get on to the worst performing ETF.
And so the worst performing ETF was the Global X Ultra short NASDAQ. It was short the NASDAQ.
Yeah. Ouch.
So you've got the top performing, it's long the index, and that beta shares one would be a passive index. So it's just basically taken US equity, geared US global shares, and then you've got the alternative, made the wrong bet, and they shorted the NASDAQ. So you can see how, and I think when you look at the 10 best performers and the 10 worst performers, they're both littered by these, what we would call thematic ETFs. They pick a theme. These ones are picking, or they pick a particular sector. We've got some of the top performers are also lithium. Some of them are, you've got semiconductors in there. You've got climate change leaders. And then you've got a crypto one in there. That's in the top 10. And then you go, this is over 1 year. And then you go in the worst 10, you have things like, shorted the NASDAQ. You've got US equity strong bear. So that'd be obviously another short one. You've got hydrogen. You've got green metals. You've got China.
Themes.
So you've got themes. You've got very, whereas we believe, be very diversified across sectors, across asset classes, and different asset classes perform at different times. And, over time, you'll do okay. In the themes one, if you do well and you get it right, you're going to win and be in the top 10. You're going to be pretty happy with yourself. But if you get it wrong, you're going to be in the bottom 10. You're most likely going to lose money. And I'd hazard a guess that, the top 10 this year, not every one of them will be in the top 10 next year. It's just the way markets work. As you've been around long enough, Sean. What's popular today is not popular tomorrow necessarily.
When it comes to the star system, so applying the star system to the top 10 and bottom 10, presumably they get some sort of points for doing well. But I just noticed in that list, there are actually some 2-star strong performers. And I presume that's because of long-term performance fees.
Correct. So it was really interesting because, I would much rather do this report completely on 5-year returns. The problem is that media and also investors, retail investors in general, don't look that far out, and they look more at, 1-year returns. And we think that's a really bad, that's a problem with the retail market, looking at very short-term returns. But that's why, because we're looking at performance over the long term and the tracking record over the long term. So our 5-star ratings are based on 5-year, 1 year, 2 year, 3 year, 5 year, 7 year, and 10 year. Remember, most ETFs probably haven't even been around for 10 years. There's only a handful when it started off back then.
Do you think ETFs, the growth in ETFs is here to stay? Do you think we're going to see, you suggested that we might see a doubling in the next few years. What is it about ETFs that people like so much?
I honestly believe ETFs are around forever and will continue to grow. I think the reason why ETFs are so popular is it's such an easy thing to buy and sell on market. It provides instant diversification and access to markets that are pretty hard to access. It's a lot easier these days to, access international shares. But if we only just go back a few years ago, Sean, you know that most of the brokers didn't even allow you to trade international shares. Then you got the Ben 40 forms and, all the tax implications of trading direct international shares. If you can actually buy them through an ETF that's listed on the Australian Stock Exchange, is domiciled in Australia, you don't have all those tax problems. It's access and ease, I reckon, that makes ETFs and diversification and low fees. The number of these ETFs are on 4 basis points. I mean, that's crazy. Most fund managers charge probably 1 to 1.2. That's come down a lot. When I first started this business, they were like 2-3%. Entry fees of 4 to 8%. So ETFs are very much here to stay.
Ron, thank you for talking to Fear and Greed.
Thank you very much, Sean, for having us.
That was Ron Hodge, Group CEO of InvestSMART. This is the Fear and Greed business interview. Remember, this is general information only, and you should seek professional advice before making investment decisions. Join us every morning for the full episode of Fear and Greed, business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.